me introduce Geert and myself. Geert van Kerkhoven, more than 15 years of experience working on the borderline of banking and technology, working with, in, and for banks to bring lending technology alive. Geert is truly passionate about what technology enables us to do, and Geert founded Oper Credits 5 years ago. He's an expert in the mortgage business. Myself, Urs Baumgartner, more than 30 years of experience in financial services. I worked for several banks across Europe in retail banking, and I joined the Oper team 2 years ago, and I'm passionate to have lenders digitize their mortgage journeys. So please allow me to give you a short introduction about Oper Credits. At Oper, our vision is to create a seamless digital mortgage experience that removes borrower anxiety and the need for paper. Our technology enables innovative financial institutions in several European countries to do this. Our journey started in 2018, and today we are active in 6 European countries. We process more than 25,000 mortgages per year, and we have more than 60 experts in-house that really are experts in mortgages, and we are backed by the best investors in fintech. So when it comes to our value proposition for lenders and distributors, it's basically about 5 main topics. First, it's about efficiency. So we help you streamline the mortgage loan application from contact to contract. So you can focus on what matters, helping your borrowers personally to have access to their dream homes. Second, technology and innovation at heart. Our cutting-edge cloud technology supports your borrowers and loan advisors with all the tools and API solutions they need, all in one platform. This way, we help you to provide an outstanding borrower experience and increase borrower satisfaction. Third, it's about paper and anxiety-free. We pave the way to a paperless future and help reduce borrower anxiety by offering a transparent digital-first experience that works. Fourth, it's about lead quality. Our SaaS solution allows you to generate high-quality leads and filters out those less likely to convert, helping you optimize conversion rates and efficiency. And fifth, expertise. We are a team of experts that have proven to build world-class tech. Moreover, know what it takes to get tech up and running in a regulated banking environment. We provide bank-grade security, and we are ISO certified. So customers of Oper experience an increase of conversion of 27% and more. They have a faster mortgage decision, so time to yes, up to plus 81%. And they benefit from an increase of first-time rights. Our ambition is to get to 90% in this regard. So please reach out to us after the webinar to get to know more about us and what we have achieved with our customers in Europe. We are happy to present it to you in more detail and provide you with a demonstration. As we operate in 6 countries in Europe today, we have insights into various European markets and its dynamics that we are happy to share with you today. Now it is time to start with the keynote and give the mic to Geert for guiding us through the trends in 2024 in the mortgage space in Europe. Geert, the floor is yours.
Thank you very, very much, Urs, for this intro. And hello, everybody. Good afternoon from sunny, well, a little bit sunny Antwerp, Belgium. Very excited to be at this webinar and also very excited to share some insights with you during this Wednesday lunchtime. So before I dive into it, maybe a quick story. So every year with the team, roughly around November, December, we start wondering a bit about, or we started a thinking exercise about, what have we learned in the market? What do we see happening? And what are, let's say, our predictions for next year? And obviously, our product team, our sales team, our customer success team, we have plenty of interactions with lenders across Europe. So it's always a very interesting debate. And actually, up until last year, the debate was always largely internally and basically more an internal exercise. And then I think thanks to the marketing team, last year we were like, look, actually, why do we keep this story internal? Isn't it more interesting to open it up to a wider audience? We have, as Urs said in the intro, we operate in 6 countries. We have plenty of clients, prospects, people who are day in, day out, like yourself, working on mortgage topics. Wouldn't it be just more interesting to share these insights, to start a discussion, to see if we have the same kind of pattern recognition, and just to make overall the European business and the European mortgage business just better? And so I'm super happy and super excited, that today we have this webinar, but also that we have packed all our visions and all our conclusions of how we see the market in a beautiful report, which if you haven't done it yet, you should definitely download. So for today, I am super excited to share these insights to you, and they have already evolved a little bit as opposed to the report we issued at the start of this year. But I also invite you in the chat to ask questions and to make this more into an interactive session, because together we will create more than if I just give you a monologue. So I will leave sufficient time for dialogue, but for now, let me just walk you through how we see the market evolve. And luckily it's the 30th or 31st even of Jan, so we already can pack the conclusions of January into our insights. Cool. So looking at the market, we have, let's say, identified 4, let's say, key topics. 2 of them more market-driven and 2 more technology-driven. I think the first one on the market side is, of course, that we see that given the current interest climate, that there might be uncertainty for you, but also uncertainty for the consumers in how the interest rates will evolve in the months to come. So we'll see a volatile environment. So that's one key thematic. A second one is concerning the green transition. We want to make Europe more energy efficient. There is the European Union with the Green Deal. Is how do we as lenders, how do you as lenders, as brokers, focus on accelerating that green transition? These are the 2 market trends, which I will discuss in a second. And then we see 2 technology waves coming up upon us. First, the coming of PSD3, open finance, and the use of data in order to reduce paper. And then lastly, the democratization of artificial intelligence through Gen AI and through LLMs, which can again then also boost your business. So these are by far the 4 big trends. Last year, November, we had, let's say, a first discussion with a small group of roughly 100 European mortgage business people. And we actually asked them what trends they thought would prevail. And well, I think with a good majority, they thought for 2024, the whole green financing thematic will prevail over, of course, also quite dominant 36%, the uncertainty in the rate climate. As you can see, we were speaking mostly to people running the mortgage business and product management side, because both technology topics weren't really upvoted, but maybe after the presentation we gave back then, that changed a little. So they were very focused on this green transition. But before I talk about the impacts on your mortgage business for the green transition, I would first like to start by going a bit deeper in the rate volatility and the response strategy. And maybe before I even do that, I would love to also take a step back to the thematic of today. So the idea today is that we talk you through the trends, but also that we give you some insights in how we see potential response strategies to basically take the best or make the best out of these trends. And when we get to that, I can also tell you what such a response strategy might have in common with the Mona Lisa and then a non-AI generated Mona Lisa. But let's first look a bit at the uncertainty that we're facing given the current volatile rate behavior. So if you look at the mortgage markets in 2023, if you look at it from a volume point of view, and this is a global number, we're basically back 30 years in the past in terms of volumes. So we are at the lowest level in volumes what we have been. So the mortgage market has had quite a test on its resilience. Also, interest rates are back to, let's say, post-financial crisis level. So we're basically entering into a new era where we are not working on negative interest rates, on low interest rates, or where actually quantitative easing isn't an effective macroeconomical measure anymore, but we are operating in an inflationary environment where interest rates are increasing. And of course, fighting inflation has in the European Union also led to the fact that actually we woke up in 2023 in a completely different environment. This is an early analysis we've done on the EU 27 markets, where you basically see that in the last 2 years, interest rates have, and I have a pointer here, right? Interest rates have gone quite significantly up, and mortgage volumes have been plummeting. And of course, we wanted to fight an inflationary environment. So what we have been trying to do is to get the house prices to come down as well. And of course, we've seen that spiking interest rates have lowered the number of real estate transactions. But if you look at overall the pricing of real estate, it has come down. But for example, in urban environments, pricing hasn't come down into the same extent as the interest rates have gone up. So the slowdown there is going much slower. So we're in a new reality. And the question you can ask yourself now is, in this new reality, what is going to happen? Are interest rates going to go further up, or are they going to go further down? And of course, there's an impact for the borrower. So if your interest rates go up, you need to pay, I mean, your debt to income ratio, your debt amount will be higher. So it will become more complex for borrowers to borrow. So if we see, and we've already seen this, if we see interest rates gone up and we keep higher LTV ratios, there will be a chunk of the population that will need to rent a property because they will not be able to afford the property, to buy a property and to become a homeowner. And this is also a very interesting graph, which comes from the German Economical Institute, on how the affordability has really, the affordability borders or limits have changed because of interest rate increases. And so that leads us a bit to the question: what is the impact of a interest rate spike or an interest rate downward trend? Today we have seen interest rates going slightly down in January, at least as in the markets where we have been operating. But if you would first consider rates going first going further up, you basically see what I just said, that first-time home buying will become more difficult, and people will tend, or families or households will tend to go further into, saving for down payments and activating certain government programs. And typically, as a government tries to make home ownership more accessible and launches government programs, you will get more complex products, you will get more balloon kind of products, so it will become more complex. While if we feel, and that's something that's happening now in January, that markets go down, yeah, probably people will still wait out for it to lower further, but you'll also see that a refinancing wave will emerge. And for example, now you have a stock of 2021, 2022, and even 2023 loans that, if interest rates would increase further, become available for refinancing. And we basically start a very transactional wave of clients that will not buy a new property, but just want to refinance on their loan. So these are the clear paths these are the paths that are very clear in an upgoing or a downgoing or in a downward trend. Of course, when things are volatile, you will create a situation where one day clients, for a certain extent of time, might apply for a refinancing, and then suddenly, when interest rates go a little bit up, borrowers might be again reluctant to borrow. And we've seen this in a micro effect happening, for example, in the Romanian market last summer, where the national bank suddenly lowered the interest rates, and suddenly you saw a lot of activity on the refinancing, which created this micro effect in Europe, where suddenly one of the larger banks in their annual statements reported a 12% increase in mortgage uptake. So for us, that's a highlight that whatever the market is going to do now, go further up or go further down, is you'll see very volatile consumer behavior. I'm also in the UK, I know, outside of the European Union now, where you see that a lot of clients are on short-term loans. As soon as people there will need to refinance their loan as well, you'll also see that there will be an impact on their DTI. So again, advocating for people that will need to think more in a solution-oriented, how can I make sure that I can still live in this house, extend my loan, and how will it be affordable to me, as opposed to just saying, hey, interest rates have gone down, I'm just going to refinance at a lower rate, so I'll save myself $1. So if you map that out on a chart, you basically will have the situation where you will be to standardize your processes and will need to get very transactional when interest rates go down. And when interest rates go up, you will need to look at your existing clients and also for new clients to really help them think through the different mortgage projects. And of course, this is a linear scenario, but what we expect, or what we see happening, is that the scenario will be more like this, where there will be volatility, interest rates will not come down completely, and hence you will need to start having this hybrid approach where you can, on one hand, be can have very personalized advice for certain borrowers, think them through more complex LTV and DTI structures, and at the same time, when markets do go down, be very, very efficient with very easy plain vanilla cases. And how that reflects back to the mortgage sales process, I can talk you through in a second. Is like this is a typical sales funnel, and how we look at this typical sales funnel is that in theory a client starts in an ideal process doing a lot of the calculations by themselves, a mortgage affordability assessment, etc. This is the, let's say, the self-serve track, and would then at a certain point in time when they become more certain, come into an advised flow. And this is, of course, the happy flow. You know, I do a lot of my activities with my family online. At a certain point in time, I look for confirmation from a loan advisor, and then basically I get into the typical origination flow. Now, if you think about it, when interest rates are increasing, as they have increased, for me, making the calculations, maybe needing to have some sort of a structure where I add a balloon loan or I add multiple durations to make a project feasible to me, or I need to pledge my life insurance to make something work. It is very difficult to capture such a plain vanilla scenarios in the simulation side. So what you'll see is that your advisory becomes much more prevalent, much more early. But again, not for all cases, because if interest rates go down, the upper flow becomes more dominant again. So that means that you will need to engineer, as a response strategy, you'll probably need to engineer your sales funnel, your sales operations, your sales technology for something that can cater for a much more hybrid flow. So your architecture will need to look much more like this, where you will have a borrower-centric user experience, where borrowers can self-serve themselves, can take a lot of actions online when things become much more plain vanilla, but also have the possibility that when markets are again going into a much more complex scenario, that your advisors can take over and can have a much more personalized and intimate experience. And again, this depends on products. This is a visualization which we've used for a while now that basically shows that not every product that you offer today in terms of home financing should get the same distribution strategy. And also there, you'll probably have some things you will need to discuss in an office physically with a borrower, and some processes you can do as automated and as online as possible. So there again, map your products. If it's a buy-to-let product, if it's a second-time home buyer, if it's a refinancer, if it's an internal refinancer or a first-time home buyer, also there you will need to look at how do I map the anxiety that this brings from a borrower. How do I map that, and how do I map that to my distribution channels? Because if you really want to offer a best-in-class mortgage process, one of the key problems you will need to resolve is the anxiety that your borrower has, and really offer them good advice. And in the current climate, we can just be fair to say that in the current climate, it will become much more complex. So borrower anxiety will be increased because of the market, and it will be your job, or our job, to be reducing that. So apart from gate technology, it will also put a burden on your Superman loan advisor that will really need to be able to cater for personalized advice. So that's one response strategy and theme, which we think will become extremely prevalent throughout 2024, before segueing into another important side, being the green transition. I'm quickly going to stop here to drink a bit of water, and then Urs, I'm going to ask you if there are any questions in the chat related to this topic.
No, so far we don't have questions to address right now, so I suggest that we immediately move on with the second trend. Thank you.
All right, cool. Thank you very much, Urs. So yeah, second one, the green transition. Just to put it in numbers and to make it tangible for everybody in the call, is that if you look at the Green Deal, the ambitious Green Deal that the European Union has put out, and if you know that almost roughly 1/3 of emissions comes from homes, if we want to meet those ambitious targets, we will need to upgrade or renovate 500,000 homes in the European Union on a weekly basis. That's huge, and a lot of homes, and of course a lot of people will, in that period of time up until 2030, change homes, but also a lot of people will want to renovate the existing homes that they have. So the financing industry and the lending industry will have an enormous role to play in making sure that people can actually afford this change. And affording this change will also have an impact on the house price. So we're seeing a very perpendicular move, in a sense, to what I earlier explained about cooling down the house prices. But early at the end of last year, we saw that, for example, here in the region in Belgium, that energy efficient houses are just increasing in pricing while the market is only cooling off for non-energy efficient housing. So here you see it per energy label, meaning that it will also, again, for borrowers, become very important to think about, okay, if I have my property and I want to make sure that my property is also my life investment, my retirement investment, or I want to make sure that, I don't, over time, I don't lose out on money, renovation and making sure that your house is at par on energy efficiency will not only have a very long-term goal as supporting to fighting global warming and climate change, but will also contribute to your own investment, your own collateral, which is your property. So consumers will be forced also to start thinking in these terminologies, and are already doing so. But it will also put an enormous workload towards you as a lender, as a broker. And I was very grateful to attend a very interesting conference in Germany last year, where the CEO of one of the largest lenders in Germany said, look, if we want to, as a lender, enable this green transition, we will need to train in 2024 1,600 loan advisors to make sure they can give correct renovation advice. Because today, financial advice or mortgage advice is very financial plan driven. But now this financial plan will need to be expanded with quite sufficient or quite elaborate renovation details of how will what I do impact the energy efficiency and the sustainability of a certain property. And the market opportunity is obviously huge. And so we go back to what I discussed earlier, is that not only will the advisory talk in 2024 become much more important for affordability, and especially if interest rates go up, but also when it comes to thinking through renovation and thinking through what is possible. Should I put solar panels? Should I put a heat pump on? What's the impact on my house price over the long term? What's the impact on my energy expenses? Is going to also, again, increase. And not only there, so we've identified along the value chain from, let's say, the first contact to the mortgage contract, a lot of impacts that we have seen on the mortgage process. There will be a lot of calculations and financial planning that will need to be added, calculating renovation, calculating the energy performance of the property, but also thinking about the property over a longer amount of time. If you loan more now to do triple glazing, will then also the energy efficiency and the energy expenses be lower over time, and can you then also increase the value of your property? And of course, to meet the Green Deal, not only you as a lender will do better planning, but also governments are issuing subsidy grant schemes to incentivize this. So this also has to come into the equation. So a lot of calculation, a lot of planning, a lot of advisory, which I already have explained earlier, but also the opportunity for product innovations. A lot of consumers, and we have tested this, are not very aware of, can I do a re-uptake on my existing mortgage to fund the renovation? Some clients might want to do renovations, but are not fully aware if they should pay it just out of their cash. Pay it cash, should pay it, or could take a consumer loan. So it offers a lot of customer retention possibilities as well. And also there, you currently have a stock of collateral. You need to do ESG reporting on that. So maybe it might also be beneficial to take in more energy efficient properties by putting a certain new product in the market to really incentivize clients to renovate at a lower interest rate. So this is then more the product innovation and the marketing innovation, which we are seeing and which we will continue to see. But of course, a renovation project and a client who commits to do certain actions on a house or on a property which is not energy efficient you will also need to verify this post closing of the loan. So hence there will also be an additional burden on your processes, on your underwriting processes, on your analysis and decision processes to look at to check the energy certificates, to have a more expanded and complex appraisal, and also when the renovation works have happened, to do post-closing checks to see if the works have actually arrived and if they have been as successful as they should have been. So actually, again, this will lead to tooling, which will include a lot more parameters than just your classical DTI LTV. It will be about the taxonomy of energy labels, of the impact of renovation works on a certain project, et cetera, et cetera. So going back to what I said earlier is that if you want to solve if you want to have a best-in-class digital mortgage process, you'll have the borrower anxiety. And when I need to personally to think about renovating, I already get a little bit anxious. I even get anxious when I have to repair my shower. But also there will be a lot of additional paperwork and checks and balances that will need to be installed. So we will also need to think about how we can reduce that amount of paper. But as I said, in the second part of this presentation, you have tech enablement, and there might be some ways you can reduce both things at the same time. Are there any specific questions on this one, Urs? Because again, I'll take a quick water break, and otherwise I continue. So let me know.
Yeah, enjoy your water. So far, no specific questions on the green mortgage part. So I suggest that we move on with the trend 3 and trend 4 at once, and then we will check whether there are any questions at the very end.
Wonderful. So yeah, if we do an average across our clients across the countries, we see that in order to underwrite a loan today, you still require, the average lender still requires roughly between, let's say, 12 to 42 paper documents that need to be verified in order to to officially grant a binding mortgage offer. Now, if we're talking about digital mortgages, and that's why we're all here, right? The question we need to ask ourselves really is, we have this paper-based process, as we used to have 20, 30 years ago when we had the Michelin map to travel from Belgium to France. Can we leverage something like Open Finance to create a Google Maps experience, which I hope most of you use today when you would be driving from Belgium to France? Because what makes Google Maps great is not the fact that it put a paper on a PDF and then made it available on your phone, so you can basically read the PDF on your phone. That's not a digital experience. It makes it great because it gives you live information on which roads are still there or which roads have traffic. If there is maybe some sort of a fair in a village, it gives you a new road. It gives you instant data traffic and then visualizes it in a much more compelling way. So if we extend that metaphor to the mortgage process, the question also remains, how can we burn the paper? How can we make sure we use data in a smarter way? And actually, you have the PSD3 regulations that now say that any lender should open up all the financial data that a lender has about a bank. And so it becomes more accessible to get that data out of databases, because a lot of the documents we use today are extracts from a database. So, but there are already a lot of data points available about the property, about the number of rooms or the efficiency that a certain property might have. Today on PSD2, we can already look into bank accounts that often have the household's accounts, that have the salary, that have the liability. We have a lot of great tools that can already check if a client is really a client, is a human being, and do KYC with them. So we feel that in 2024, because of volatile environments and because of energy efficiency, the paper burden might increase. It is actually the right time now to embrace data sources and start working with APIs as opposed to additional check and balances on documents. And we've done the experiment for the Belgian market, where we feel that these data sources, which are available today, can already reduce paper exchange by 70%. This is a massive business case. If you look at the top 10 requested documents in Oper today in Belgium, I'm not going to read them out loud, but they go from an ID card to a fire insurance policy. We have identified that basically with data sources that are available today, that are callable through API, we can basically make the data collection easier, make sure that we get the data from verified sources, and through digital signing, do not allow this loop of getting a wet signature, because we can get a qualified signature through, for example, in this case, DocuSign. And this will put a lot of workloads out of the hands of your back office employee, and will make it then also easier for your advisor and your borrower to get an indicative offer much faster, and will again then expand pre-approval quality. So we feel that Open Finance and the data sources available become mature, become more vetted, and can really help you fight complexity on the green financing on one side and on the volatile environment on the other hand. And I'm quickly going to go to the next trend because I'm watching time, and then we have still 10 minutes for Q&A. A fourth trend, the Open Finance is a very, very important lever to make sure the first time right and the time to yes on your back offices improve. But your advisors could already really benefit from the Gen AI evolution we are seeing now. Why? Because I know AI again, and I think the last year, all the media outlets have been full of it. But what we think is really disruptive in terms of this change is that if you look at the AI before we had ChatGPT or before we had these first Gen AI models, was that a lot had to be modeled on your internal data models, especially machine learning neural networks. Were trained on internal data. And the problem you had there is that to train the models, you need to have access to your data. And when data sits on-prem data centers, when data sits often on mainframe technology, cleaning the data was 80% of the work, and hence it would be slow, and not always you would have all the data available to you. Now, after using these language models, basically that can connect words, that can basically output qualitatively vocabulary, you can basically use public models and infuse them on your data sources, meaning that you do not have to train models anymore by yourself, but you can basically source in models to basically start engaging with clients. And this can lead to clients that are anxious, that are getting through self-serve, that can get personalized journeys, but also your loan advisors that do not always know your product policy, that do not always know the more complex environments. They can also use co-pilots to be more guided throughout a sales journey. And we've worked on a co-pilot that basically sits in a virtual Teams conversation that transcribes the conversation that a loan advisor has with a borrower and afterwards presents it in an FAQ. This way, the client, the borrower anxiety can get largely resolved, but also the advisor gets more help in following up a sales conversation in a much more structured way. And also around document interpretation, as LLMs can lead language, you can also, on the back office side, make a lot of improvements there. And so, is the glass half full or glass empty? There's still a lot of work to be done. But the great thing about Gen AI is that all these models are already trained on data, that they're out of the box available, and that you can actually start experimenting with it, that you can really offer in a matter of weeks to your loan advisors a co-pilot. And in our report, we also did the reverse business case. If you look at green financing, if you look at Schwabes Hall that is training 1,600 loan agents, imagine that you could release a co-pilot helping your loan advisors to give good efficiency and energy advice. And you could build such a model in 3 to 4 weeks. You could save on a lot of training hours, and you could actually give much better advice or help your advisors in a much better way using such an energy co-pilot than basically giving them a training and then having to do checks afterwards. But still, is the glass half empty? Gen AI models are not always very explainable, and especially customer facing, this can bring risks. So we see more direct opportunities going into the direction of assisted advice than into direct making it borrower facing. And this is what I told you about the co-piloting and the frequently asked questions with what we've been experimenting in the past couple of weeks and months. And also, of course, around product advice. As products become more complex, this can have huge potential with plainly straightforward democratized algorithms, because I think the big change is that the cost to develop these models has radically reduced. And every time we do this as human beings, we make a great step forward. So conscious of time, to tie it all together, we feel in 2024, we will still be operating optimistically into an uncertain environment. We do not know where the interest rates are going to go. Now, we have a lot of optimism that it's going to go down, but still we are having these energy efficient housing requirements, which will make the borrowing journey still more and more complex. So we feel the opportunities really lie now in this climate. Make sure your advisory processes are omni-channel, that you can really switch between channels easily. You can distribute products according to the most appropriate channels, and this way get to fast time to yes for your clients, also optimize on your first time right in a sense, but also make sure that you build very compelling journeys for your clients. We feel also that green mortgages and especially green financing can be a very powerful retention tool and an acquisition tool. I think today there are still a lot of lenders lacking the capability of giving really clear, good advice of how and when you should renovate. And I think their first market mover can still build a very valuable case. Reduce the paper. So by doing this, don't add more paper burden to it, but start embracing an active data source policy, start connecting to the data source available to them, and that way try to get from 20 documents to 10 documents because it's feasible. And lastly, support your advisors. Again, LLMs are out of the box available. Building a co-pilot can take weeks, doesn't take you 2 years to do it anymore. Experiment with it and really bring that value as opposed to doing it the classical way. And what does this now have in common with the Mona Lisa? Well, the Mona Lisa, as well as your response strategy, they're both going to be a work of art because you'll need to be ambitious. We've been through a crazy downturn. Everybody here had loads less volume. So let's use that momentum to build an omni-channel digital mortgage strategy, which can cater for wherever the market goes, because that would be resilient. And we feel technology and good processes can really help you to that. And we feel in this world, in order to be successful, to be ambitious and resilient, you cannot do it alone. There are some amazing technology companies out there that can help you with appraisal technology, with KYC, with building LLM models, or offering you the full end-to-end stack as we do. But it's an ecosystem play. And we feel if you can embrace those three values, you can build a wildly successful mortgage business in 2024, and you'll be ready for any direction where the market goes. And that's very fastly how we see the market, how we see a response strategy. I'm very happy to dive deeper into any questions that might be arising now. I pass the baton back to you, Urs.
Yes, thank you very much, Geert, for the presentation. So just to let you know, the presentation itself, you can have a look at it again in the recording. So as I mentioned at the very beginning of the webinar, the recording will become available on the LinkedIn page of Oper Credit. So stay up to date through there. And we have indeed questions. So one question is whether Oper provides the calculations when it comes to energy efficiency. So that was a question that was arisen in the comment section.
Yes, that's a good question. So the energy efficiency calculation, so Oper embeds energy efficiency calculations in the advisory conversation. For the exact calculation logics, we work together with localized partners, because there we have learned that each market has specific requirements. And so typically we work together with local partners to get the values, meaning very simply said, if you install a heat pump, what is the impact on the energy label, etc. That data knowledge we source from a third party, and then we embed it into our advisory tooling.
Very good, thank you so much. Another question when it comes to the green mortgage trend is, do we see an increase in government help for renovations? And do you believe that without these helps, borrowers would really spend money and take mortgages for the sole purpose of doing the renovations?
I think I'm very bullish on more grants in that sense. So I think we will see a lot of subsidies coming still on this one. But governments are not very good in building sustainable government subsidy programs. But that's another discussion. But and will borrowers do it by themselves? Well, I have a very funny data metric then for the question for the person asking the question, is that in the Netherlands, the initiative of people getting renovation loans was super high at a certain point in time in 2023, but that was directly correlated to their energy bills. So I think borrowers will change, but they will only change when they really feel it in their pockets. And the pocket can be the energy bill, or it can also be the fact that if you do not renovate your house, the value of your property is just decreasing drastically, and that will urge people who still want to sell or who want to get a retirement, basically sell the house to afford the retirement, to basically do the works. So I think that will be more a trigger from the borrower side. It's unfortunate to say, but that's I think what the data tells us right now.
All right, thank you very much. When it comes to the 4 trends, which of the 4 trends do you expect to have the most impact and strategic relevance for the lender and the distributor?
I think if I take a few steps back, I think for a distributor, and I really believe that in anything that comes, we really need to rethink the way we provide advice around the mortgage, because clients will seek for lenders that can respond fast, that can respond clear and transparent, and as digital as possible. And I think that is something where a lot of work is to be done. And then for me, if you do not have that clear, if interest rates, any way they go, clients will get lost and the Green Deal will not disappear. So hence mortgage applications will become more complex. So I feel those 2 trends will have an enormous burden on the way you engage with your existing and your new clients. And I feel that if you tackle that well, there was tremendous success to be had. If you don't, I think you'll see it in your data.
All right, thank you so much. And one last question, when it comes to artificial intelligence and open data. So what could be a step-by-step guide to start working with artificial intelligence and open finance?
That's a good one, and we're actually writing something about that. So it's maybe for the next webinar I can give a detailed answer. But I would say experiment, and then don't make it too big. It's a tendency we all have, is make things way too large. So for me, it's for example, if you do virtual just a very simple example of an experiment. If today you do 20% of your conversations with virtually on Teams or WebEx or whatever, transcribe the conversation and feed it to an LLM model. That's a very simple experiment. There are many models out there which keep the data, so you don't have to share the data with the model, but you can keep it for yourself, so it's secret. And a few simple API calls and you get it running. I mean, our product team got a working version of that in under 2 weeks, working 20% of their time on this. So basically 2 man days. So experiment, and if it works, start building a project around that.
Okay, thank you very much for that. And thank you very much for joining the webinar. So that was the last question. If you have any additional questions, just feel free to reach out to us, or leave it in the comment section here as well. So the contact details you see here on this slide. And download the Mortgage Trends Report 2024 that is available on our website. And again, the video here of the webinar will be provided soon on the LinkedIn page of Oper Credits. Feel free to reach out to us to have an exchange on the challenges when it comes to the mortgage business. And if you're interested to get a presentation of Oper, of what we do, and a demo of our solutions that we have in the European market, feel free to contact Geert or me in this regard. So by this, I will end the webinar and wish you an amazing day and a rest of the week. Thank you so much.
Thank you very much.